I'm Doris. I'm here to share with you about my stock account. Today, my stock account has made a loss of $965. Today, U.S. stocks closed higher, and the S&P 500 closed with a gain. So let's first take a look at my account. Today, the P of my account is a loss of 1.29%. Right now, the net asset of my account is $73,946.71. Today, United Natural Gas and the SQQQ both made a loss of 1.2%. And the market generally closed slightly higher, and the auto industry led the gains. The S&P 500 rose to its highest level since August, and the CBOE Volatility Index hit its lowest level since 2020. S&P 500 rose 0.39% this week, marking its first straight fourth-week gain since August 2022. The Dow rose 0.34%, the second straight week of gains, and the Nasdaq rose 0.14%, and its seventh straight weekly gains. The Chicago Board of Options VIX Index, a measure of market panic, fell below 14 to its lowest level since 2020, suggesting traders mostly avoided the protection offered by put options. Fund Strat Market Newton, head of technology strategy, is optimistic, while VIX on the downside and the short-term bearish call ratio has plunged to near a small pullback. The price action has not indicated a pullback is coming. Investors are encouraged by the signs that small stocks are also joining the recent rally. The fear index has covered into greedy zone for the past week and entered the extremely greedy zone on Thursday. The investor confidence index showed investor optimism above the average for the first time since February. It is not clear whether this recession themed short squeeze or whether it'll move as August 2022 did in August or continues a rally. We think we're at the fourth fork point. Last week's jobless data has beat expectations and reinforced investors' expectations that the Fed will keep interest rates unchanged at the next week's meeting. The Fed's interest rate range is now from 5% to 5.25%. Last week's jobless claims data may be volatile, especially since this week also included Memorial Day holiday, but since it is just ahead of the FOMC meeting next week, it is becoming increasingly important. Even if the data shows that the labor market is still quite tight, it is cooling down. The Fed's monetary policy decision is likely to be affected by the May Consumer Price Index report released next Tuesday, so traders should be happy if CPI inflation continues to fall from the current 4.9%, further encouraging the Fed deposits rate hikes. The Bank of America strategist said the earnings recession has lasted for several quarters and the expected EPS to bottom in the third quarter of this year. When price versus earnings ratio rise. Historically, over the past 50 years, the S&P 500 has had exactly 20 times earnings. 2 weeks ago, Savita Subramanian, the chief strategist at Bank of America, one of the big shorts, finally gave in and raised its S&P year-end price target to 4,300 from 4,000. Subramanian, an important factor for his hesitation to abandon his long-term bearish review is that many customers have been asking Bank of America if the statement is so negative and if everyone is selling, why is the S&P 500 trading at 20 times earnings? Subramanian said, U.S. stocks are indeed statistically overvalued by many indicators. In fact, in her assessment, 18 of the 20 indicators are overvalued, with free cash flow and historically standardized earnings per share not overvalued, only due to pessimistic capital spending expectations. The earnings recession has been going for quarters, and there are many factors that are associated with the S&P 500 20% earnings. Since there is a global financial crisis, the S&P 500 valuations have been much more associated with quantitative easing than earnings, volume, or other factors. In fact, Her analysis shows that the Fed's quantitative easing has explained more than half of the U.S. earnings growth since 2010, and that the price-to-earnings ratio of super large growth stocks is even more correlated with the quantitative easing. Now, with the Fed's quantitative tightening, super money expects such companies to face more stock pressure. According to her, excluding the 50 largest stocks, the S&P 500 trades just at 15 times earnings, below 18 times the historical average. Most cyclical stocks have a higher risk premium than average, reflecting recession risk, while defensive and long-term growth have a lower-term risk premium. Standardized earnings valuations are highly explanatory, but are limited to long-term returns. Historical P/E ratio have been low because to predict about the long-term trend. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.